All right, I believe the time has risen. Here we are. It's 7 p.m. Central Time, Wednesday evening. Want to welcome everybody. So if you are tuning in tonight, we're actually broadcasting to a number of different sources tonight. So if you guys are tuning in tonight, welcome, whether you're joining us via GoTo, whether you're joining us directly in the TheoTrade chat room. We again welcome you to tonight's presentation of what to expect in the markets. You should, of course, see my slideshow right now. And again, we are off and rolling here. I'm going to do kind of a quick introduction because some of you that are joining us tonight, again, are TheoTrade traders, TheoTrade members, and some of you guys joining us tonight. We've kind of holding an open house over here. So we've got, again, questions coming in on both sides. I'm going to try to grab as many questions. The one question that's always comes up, is this being recorded? Absolutely, of course, we're going to record everything. We record absolutely everything here. So quick risk disclosure. I throw this up here. We are not financial advisors or a broker dealer. The reason I mention that is, well, here's a bit about me. My name is Don Kaufman. I'm the co-founder here at TheoTrade. I spent 15 years in the brokerage industry. I was at the startup thinkorswim. So I started trading in Chicago in the late 90s, 3 weeks out of college. A couple of years after that, I was invited into a startup firm, which was at the time a no-name firm called thinkorswim. Lo and behold, thinkorswim was eventually acquired for about $600 million. There was another acquisition, and it became, of course, TD Ameritrade. I ended up running the education division of TD Ameritrade for the last couple of years prior to, of course, starting TheoTrade over here. So again, 18-year trading career. I do have 15 years of thinkorswim platform experience, although that's not the only brokerage firm these days that we do deal with. But by all means, again, you have thinkorswim questions. Yes, I am very aware of the thinkorswim trading application prior to refer to it a couple of times tonight. We're going to jump right into it here. So again, I want to welcome everybody, and I don't like formal introductions. I like to jump right into it. You guys are here because ultimately you want good education, and that's precisely what we are going to do. Now, make no two ways about it. Tonight's session is recorded, and there's a reason it's recorded, because this is going to be fairly hardcore. Now, some of you have some experience, and we're going to give a little bit of background about what risk and volatility happen to be. But when we talk about what to expect in the markets, people kind of get that all wrong. So what to expect in the markets? Well, first and foremost, I do have a number of PowerPoints that I'll go through tonight, and I'll be more than happy to provide these PowerPoints thereafter. But I'm going to use a lot of live examples tonight because I just, over the years of coming out, teaching some classes and, the years of trading experience, you just find out, hey, putting it into context of a live market condition is far more useful than going through a theoretical. I'm not going to show a whole lot of charts. In fact, you're probably not going to see many of any charts tonight about, hey, what do you think this stock is going to do? What to expect in the markets is about being forward-looking, okay? So to begin with this, last week I did a session here at TheoTrade, and I did a session on volatility. We're going to recap a little bit of that volatility session, and then we're just going to dive head on into it. So again, I think you guys will enjoy what we have in store for you. If there's topics that kind of do it for me when I'm coming out and teaching this, this is one of them. I like talking about volatility. I like talking about probability. I'm all about expected move over here, and I want everyone to know right up front, yes, this say option markets. You don't have to trade options. It is fine. Whether you trade stocks, you trade options, you trade futures, okay? I'm all about it, and that's absolutely fine. You're going to find that a lot of this will pertain to any style of trading. I'm just going to give you a very different viewpoint, okay, of the markets. In fact, some of you, you're going to be ruined after this tonight, the way that you view markets. So let's move onward and upward over here. Sorry, reading some of the questions. You guys you're killing me already. So option markets can be thought of as putting a price tag on a risk. Okay, so one of the first things I always like to define in risk and volatility, they're synonymous. Wall Street many, many years ago came up with a word called volatility. And most people are like, oh, volatility is movement. Well, yes, but that's a secondary definition. Okay. In the end, volatility is synonymous with the risk. When things are volatile, okay, that means markets are moving around quite a bit. That's a lot of risk. But, okay, the one thing that we're going to go through tonight is what this really pertains to. So I start with option markets can be thought of as putting a price tag on risk. Pricing in markets is determined via market participants. Ultimately, option pricing comes down to supply and demand. And that's one thing that people fail to see, okay, in markets. So before I go any further, and again, I told you I was going to bring up quite a few live examples. Now, whether you have experience in markets or not, I love this. The first thing I pull up, of course, it's a chart. Well, I promise I won't show too many of those from this point on. If you guys want, jump in here, give me a stock. Any stock you might want. Jump in here, huh? Does anybody? Apple? Come on. You were going to mention Apple. It was going to happen, but feel free. We'll make this an interactive session tonight because, again, I want you guys to get the most out of the session. So let's make it stocks that pertain to you, right? So, wow, somebody UVXY, TSO. Ooh, little city out there. Oh, dangerous. Facebook. Okay, Facebook was Mr. Toad's wild ride today. But let's start with Apple. By the way, seriously, Facebook was Mr. Toad's wild ride. There was a report that came out. They weren't doing as well in the advertising dollars. Stock moved in a ridiculous range today. But I'll start with Apple, okay, because everybody expects me to. So this is what to expect in the markets. The first thing I'm going to tell you is that, in fact, let's have some even more fun with it. Let's start on the chart, okay? So I worked in the brokerage business for 15 years. And when I say I worked in the brokerage business, I wasn't a guy that just picked up a phone and be like, so how may I take your order? Would you like fries with that? That wasn't exactly me, okay? There's a couple of things. Number one, we built a lot of the education that to this day is used, all over the entire industry. Number two, had a lot to do with some of the input of the tools that go into the trading application. So the one thing I'm pretty familiar with is something like looking at a chart over here. When you look at a chart, and let's put it into just everybody so everybody gets this. When you look at a chart, what are you really looking at? And I know you're expecting a lot of PowerPoints and so forth, but again, that's just not me, okay? What are you looking for in this chart? Looking for direction, looking for oscillation. But really, what is a chart actually displaying to you? All right. Ooh, somebody wants to look at Intuitive Surgical. All right. UA, I like it. Bank of America, which is coming up with earnings. But what are you really looking at in the chart? There's only two things truly visible in a chart: price and volume. That's it. Okay. That's it. Price and volume. And everything is to the past. Okay. So and the reason I'm breaking this down, and I'm not picking on you for looking at a chart. Over the years, I have been called an anti-chartite. And that is not fair. It might be a little bit true, but it's not fair. I grew up as a quant. I'm a trader quant. But the point I make over here is when you look at the bare bones of a trading application, this trading application, whatever trading application you use, is nothing more than a data feed. And that data feed, it sees volume, it sees price. Oh, yeah, and it has little icons over here of what happened in previous earnings, dividends, yada, yada, yada. But there's nothing more than price, and it paints the price on the chart. So every technical study that you have, okay, and again, we'll have some fun with this. Right now, there's over 400 different technical studies right here. And yeah, I'm on thinkorswim, but I'll hop on a TradeStation for you. I'll hop on to whatever brokerage firm you want. And they're all going to have hundreds of different studies. Find me the golden study. Oh, please do it. Do it to me. Every one of these is based on the exact same thing. What is it? It's based on price and volume, or just price. Some of them just volume. Some of them have volume and price, and other ones have volume and price. That's it. Some charting packages can pull up implied volatility, some option charts, but yada, yada, yada. That's it. We need to know what to expect in this market. When I say this market, okay, I don't want to hear what happened yesterday. There's earnings coming out in Apple. Wake up. What's going to happen in the earnings? Okay, what's the market dictating to you about earnings out here? And that's what everybody wants to know. They want to be able to predict. I need to see here, and are we going up or are we going down? Well, we're going to give you some, definitive explanation of what the options market has to do with that. So, before I go back over to the PowerPoints, and I will, I'm going to deviate back and forth. I go over here to the Trade tab, and this is an options chain. Now, some of you are familiar with options, some of you are not. It is fine, Options have different expirations. There's a 2-day, a 9-day, a 16-day, a 23-day. And again, regardless of your experience level, we're not going to get into, straddle swaps and iron condors and any of that. I'm going to get into an area of trading, that can help, across, whether you're an investor, whether you're a trader, even if you trade currency products, you can use this stuff to your advantage. So all these different expirations, what are the options in Apple being priced on? Like, what is it really saying? Like, when you come down to it, like, people forget, like, what an option is, and you start trading them. And even those of you that do trade them, you kind of forget what these things really are. And you got to sometimes take it back to, like, again, a little bit of the beginning. What is a 30-day option? All it's doing is trying to put, an estimate of risk on Apple 30 days out. And it does a pretty good job of that. And you go, how do you know it does a pretty good job of that? Well, let's look today. Today in Apple, 536,000 contracts. Like, they traded hands. 536,000 contracts. Now, for those of you that have no idea what a contract is, contracts, well, they're ultimately do what? Put a couple of zeros after that there. One contract's equivalent to 100 shares. So when you start looking at this in, like, context, you're like, phew. I mean, this is a monster amount of capital that is being traded on both sides. There's both buyers and sellers for these options. And what these options are doing, it's actually telling you what is to be expected of Apple in the next 23 days, the next 30 days, the next 37 days. That's what the options market is doing. So one of the things over the years of building all these, like, financial tools and building tools around financial education, one of the things that always shocked me is that in most of the charting applications, like, nobody ever spends any time out here. I don't spend any time, like, taking the options data and then plotting risk. And I'm going to show you not only how to do that, but how to make it effective for you. Like, how can I take this tomorrow, literally tomorrow, and use it in my day-to-day trading? And some of you, again, that you join us on TheoTrade on a day-to-day basis, you're like, I already get this. I get it. Some of you are a little bit newer to TheoTrade. You're like, I'm not exactly sure. So, some of these, kind of coaching sessions, we take it back to square one to make sure that everybody is kind of on the same page. So many of you do carry positions. Many of you, have some trading experience. Whether you do or not, though, isn't necessarily, the point over here. Let's jump back again. So pricing in markets is determined via market participants. One key factor over here is when people talk about options. Options pricing, again, comes back down to supply and demand. It's not like when you think about pricing, and the reason I'm kind of mentioning this right now, when it comes to markets and options, there's this kind of myth that the market maker is responsible for pricing. There's also a myth, like when you look at a marketplace and an option might be trading at, $2 at, for instance, 205. And people look at these option markets, and then this basically means you could be a buyer here and you could be a seller there, right? That's it. That's the market. It's 205, $2. I could buy it here, and 2 seconds later, I could sell it there. I could sell it here. I could buy it here. Great. You can do whatever you want. It's a fair and a two-sided market. But there's kind of that, like, myth out there that, I don't like it. It's not a fair market. I mean, I get that. Again, so many years in the market, they're like, somehow, somebody, somewhere, it's not fair. You're kind of feeling like you're getting screwed a little bit. But if anything in the world is overpriced, what would you do? What would you do if something was overpriced? You turn around and sell it. If anything in the world is underpriced, what do? You buy it. Okay, so don't believe that these market makers have any control. Market makers are sitting ducks today, and really what you got. You have 12 different option exchanges, and competition breeds efficiency in pricing. Options are an amazing tool, though, for efficiency in the markets, and that's what I'm kind of getting down to. Now, before we go any further, it's very important to go through a little bit about volatility. So let's get down to again, we talked about, volatility being kind of synonymous with risk, but what we're talking about here, and this is a quick recap of what I've been doing lately at TheoTrade, it's implied volatility. Okay, volatility. Well, first and foremost, there are two types of volatility. There's historical volatility, which, yes, it's the annualized standard deviation of the past stock price movement, and there's implied volatility. What's implied volatility? It's what sets an options price. Okay, and this is like an age-old, I've used this slide since, the beginning of time. Okay, there's a $100 stock with a volatility of 20%. This is the area that people don't get about options. Options can be used, the option volatility can be used to describe stock price movement. So a lot of people, they take stock price and they try to extrapolate things via stock price. Okay? Me? No. I'm actually taking the options market, because the options market's putting a price tag on risk, and I'm saying, what's the option market actually say about the stock? So one of the things that people talk about all the time in the market is like the VIX. Okay? How many guys have ever heard of the VIX? So again, quite a few people joining us tonight. How many people have heard of the VIX? Almost everybody, right? So sure, the VIX, it's the S&P 500 Volatility Index. Okay, and if you turn on like CNBC, you got Bob Pisani on the floor of the New York Stock Exchange and like, the VIX is down 2, the VIX is up 3. What does it even mean? You're like, it's a risk gauge. It's the mother of all risk gauges in the market. And I'm like, yes, but what does it really mean? Well, now you're going to know what it means. Let's say like the VIX is at 20%, and you have this $100 stock. What it really, really breaks down to is this. It means that stock can move, okay, down about $20 or up about $20. 20% actually equates to stock price movement, and it's a 1 standard deviation. Now, as soon as I mention like 68%, that's kind of typically when people go, oh, hold on there, little hamster gets stuck in the wheel. I get it. All right, 68%. I just pulled that one out of thin air. But this is a distribution curve. And with the distribution curve, and any distribution curve, that was the worst distribution curve that anybody has ever drawn in the history of mankind. But in the distribution curve over here, what you basically get, right, everything you can do in your life falls in a distribution. And I always use this same kind of analogy. Whatever city you're from, we were started with that. And when I say we started with that, I was kind of curious where everybody was joining us from. I actually got a couple of people from Arizona. By the way, I am broadcasting from Scottsdale, Arizona. Why no longer Chicago? Because the weather sucks. Pretty much all year long. I am sorry. I love it in Chicago. Okay. Oh, Tucson. Oh, I went to high school there. Anyway, it's Chicago. It's a lovely time of year. Just like snowed a couple of days ago. Could be worse. You could be like in Alberta, Canada, which somebody just chatted in that they were from. Anyway, I always use this, wherever city you're from over here. Chicago rocks. What are you, a Cubs fan? Okay. Whatever city you're from, there's really, really good drivers up here, right? And there's really, really bad drivers down here. But most of us, we fall into the meat of the curve, which is about 68% of all occurrences. So the way that this actually works is that volatility equates, again, to 68% of all occurrences. And you're like, okay, so what? How does that actually help me? Okay, this marketplace is screaming to you right now. The option marketplace is screaming to you. The most likely occurrence of the stock is going up about $20, okay, or down $20. And this is what we call plus 20 or minus 20. The issue with this, okay, nobody's actually asked the question yet. Oh, there is a Cubs fan in there. There's always one in the group, right? By the way, I've been forced to go to the Cubs game. I work for TD Ameritrade. The owner of TD Ameritrade owns the Cubs. It's actually pretty good seats, too. So if you take a look at this stock, all right, it's a 68% chance of being in this range, and that's within 1 year. Okay? But the fact of the matter is, what good is 1 year going to do you? I don't care how far the stock moves in a year. I need to know how far a stock moves. For instance, what's the next 30 days? What's the next 37 days? What's the next, 45 days? Well, I'll tell you what, the options market now, okay, and this is something that people haven't necessarily thought about, but the options market these days, they added all these weeklies. Weeklies has totally and completely changed the landscape for the markets. Okay, now I'm going to have a fun little story here. So part of the education over here, a little history on the markets. Back in my younger years, so I actually did join thinkorswim when I was 24 years old. It was in 2000. So if you do the math really quick, I was 24 then. I just turned 40 like a week ago. 40! The warranty is over on me. So I am officially out of warranty. When I was about 26 years old, I went to the Chicago Board Options Exchange with the group of traders from thinkorswim and the two original founders of thinkorswim. We did a presentation in front of the Chicago Board Options Exchange, and that presentation was presenting to them the idea of an expiration that happened every single week. They came up with the idea. So, I'm a kid at the time. I'm 26 years old. I'm like running the slideshow back there. And the weeklies were not originally called weeklies. Okay? There's no joke to this. This is true. They were not originally called weeklies. When they first designed the product, they're actually called the Quickie. So the entire meeting at the Chicago Board Options Exchange, you guys know it, they're a pretty serious bunch over there. They're like, oh, everybody's going to want a Quickie. And I was just like, oh boy, it fell flat. Anyway, the idea, though, took off. And one of the reasons for weeklies was very self-serving as both a trader and a brokerage firm. Number one, add weeklies. People trade more, right? More expirations, they're going to trade more. But one of the key elements of weeklies that has always been missed, okay, people don't think about stuff like this. Adding weeklies gave us as traders incredible insight to what the market was expecting 9 days and 16 days and 23 days and 30 days and 37 days. Every nuance, okay, and every little inkling of the market could then be determined. So we could, figure out what the market was expecting in terms of risk. And that's what we're kind of trying to do tonight, is to explain to you and then further explain to you, like, why does this actually pertain to me? Okay, and that's one of the most important things here is let's make anything that we give you here tonight or whenever. Okay, I mean, we do, again, tons of different classes and, coaching sessions, 6 coaching sessions like a week. We're in our chat room doing classes every single month. Everything has to be, okay, not only obtainable information, but something you could take and use it like literally tomorrow. So grab this piece of information, if you will, and we're going to move a little bit forward. And I promise, if you're a little confused right now, we'll clear it up. Implied volatility and expected price moves. So what does implied volatility delineate? Implied volatility is the volatility that justifies an option's current price, right? How can I use implied volatility in my day-to-day trading? Implied volatility can be extrapolated into stock price movement, or what is termed expected move. So, of course, the logic tonight is what to expect in the markets? It's expected move, okay? Moving forward over here. These are what we call expected moves. Given if you have volatility and a stock price, you can actually solve for how far, okay, a stock can move within a given period of time. Now, there's not going to be, and I promise, there's not going to be any mathematics that you're going to have to do on your part to be able to use this. You don't have to necessarily have the thinkorswim trading application. I'm going to go through those kind of nuances as we move forward. Just know that whether you're 30 days, whether you're 60 days, whether you're 90 days, we can tell you with a high degree of success, 68%, okay, what the stock is likely to do. Now, your first thought over here should probably be along these lines. If it moves in this range 68% of the time, what's going to happen to me 16% of the time out here and 16% of the time out here? And go, oh, don't worry, you're going to find out. You are going to find out. Now, let's move onward and upward over there. By the way, what about the options exchange itself? By the way, the options exchange, so they bought the product. So the end of the story is they bought the product, the weeklies, from the original founders of thinkorswim, and the Chicago Board Options Exchange took the product and they made it, a listed product out there. It took a few years to finally take off, but it really has. Like, weeklies have revolutionized not just the options market. Forget about the options market. It's revolutionized how risk managers, and how traders, how they obtain information. It really has changed markets, and I cannot stress that enough because it's something that's just not really discussed often enough. Okay? Expected move and probability. Expected move defines a one standard deviation move, which occurs approximately 68.3% of the time in a given underlying. Now, don't let this freak you out at all. We're going to be just fine. Therefore, there is a 68.3% probability of an underlying closing inside the expected move by the designated expiration. Expected move is what we term a probability of expiring inside a given range by a specified date. Now, let's start to take this into the context of the marketplace. Okay, so we're going to start to really bridge the gap. How I'm going to use it. Not every trading application has expected move. You can use what's termed an at-the-money straddle as an alternative to the expected move. Now, we're going to go over to a trading application, and I'm going to show you all the odds and ends, and then we're going to spend, a good 20, 30 minutes going through different examples of how do I use this? Why do I use this? Because at this point, you're spinning. It's a lot to go through. Back over to Apple. So, which expiration might you want information on? Do you want to know what Apple is likely to do for 2 days? For the next 9 days? For the next 16 days? What entertains you? Okay? In terms of expiration. To me, there is one that stands out here. And I'll tell you what it is. Okay? 16 days out from now, Apple's actually going to release its earnings. All right? Apple's going to release the earnings announcement. And when they have their earnings announcement, that increases the risk. The markets are already, and have already, months ago, priced in that amount of risk. So, to distinguish this, we're going to open up 16-day options here. Okay, we'll look at volume and open interest. I just want you guys to know when I say volume and open interest, this is the number of contracts that are, currently open inside of Apple. Now, we've done some Options 101 courses recently that explain every nuance from volume to open interest to what the bid and ask are, everything. It's not critical right now that you understand options. What is critical is understand this, okay? In options, every unique expiration, when I say unique expiration, whether we're looking at, again, a 2-day, a 9-day, a 16-day, right? Every one of those expirations has with it a unique implied volatility. That means there's different risk for different time frames. So remember a moment ago, we looked at this kind of distribution curve. Well, you know what? For 2 days, the risk is 24%. For the next 9 days, the risk is 24%, right? So here's the 2-day expiration, and it's got 24% risk. Here's the 9-day expiration, 24% risk. All of a sudden, what are we at with the 16-day? The 16-day is whoa, it has 35% risk. Now, why does it matter? Because you can take that 35% and you can immediately extrapolate it to what the stock is going to do in the next 16 days. So let me show you why this is important. Okay? And then we're going to get into, again, real trading example. So I'm going to close up, in this case, I'm actually going to close up the option chain completely. Nothing to see in there. What you're going to look at is a distribution curve, just like we plotted a moment ago. I mean, this is the same thing as the VIX. And here's this distribution curve. And this distribution curve, it's only good for the next 16 days. And this distribution curve in this period of time has approximately a 35%, and that's what we're going to call its volatility. Volatility comes from options pricing. It's derived from the options that are priced only in this 16-day window. Okay, that's it. What does it mean? Okay, it means what we term expected move. Now, Apple right now is $112 underlying. What this really means, expected move is equivalent to plus or minus $6, okay, and we'll round it over here, and 60 cents. So it kind of means, what can Apple do? It can move up over here to what? Let's just call it like 118, or down over here, which is what? About 106. That's it. There's the minus 6. Here's the plus 6. What do we get? We stay in this range approximately 68% of the time. That's it. That's what expected move happens to be. Now, time out there. Okay? When you are looking at this, how can you use this information? I mean, that's one of the most important things. How can you use this information, okay? Because this information is easily obtainable from any trading application. Even if you do not have expected move on your trading application, I'll show you how to do it without ever having to have expected move. What can you do with it? So that's what we're going to really come into here momentarily. I want you thinking about it, though, right now. What can you do with it? Okay, time out for a second. Depending upon which trading application you may have, you may not have these expected moves on the right-hand side. Okay, so thinkorswim, they've got what? They've got the volatility. Right next to it, they have the expected move for every expiration cycle. If you don't, you use what's termed at the money straddle. I'm going to make this super easy. Okay? Wherever the stock is, you're going to look at the call and the put adjacent to wherever the stock is. Now, again, you may have zero experience, okay, with options. It's fine. Watch. I open up the 16-day options. Now, again, any trading application that you can have is going to have an option chain on it. If they don't have an option chain, I'm pretty sure you have to leave. You just pack up and go bye-bye, because this is what the market is now. Even if you don't want to admit that, hey, there might be something to this options. Look, the option marketplace, when I say the at the money, okay, right now, the money is the stock price, 112. Look at the calls, okay, and the puts. And what those ultimately are, everything out here is calls, everything over here on the right side of the screen is the puts. Add them up. This is trading for about 325. This is trading for about 320. Just add those up, okay? Fast and dirty math. What do we get? $6 and 45 cents, right? $6.45. Well, the expected move, the real mathematical solve for expected move is $6.66. But this is good enough. It's good enough for you. I mean, that's why, again, doesn't have to necessarily be like the thinkorswim application. So let's do it again. Let's do it again over here. And it could be the next 2 days. Like, what is Apple priced to move the next 2 days? Well, all we have to do is look at the information. We could, number one, we could look at expected move, which is $1.80, or you could just add, okay, the 112 strikes together, and what did it come out to? Now, this expected move, it's just a little difference, 86 cents plus 82 cents. All right, so you're looking at like, $1.65, $1.80 and change there, give or take about 10 cents. That's it. That's all you have to do to figure out expected move. Okay. Now, again, I'm going to show you why this is so important and where you can use it here. I just want to make sure that everybody is comfortable. okay, with that idea. And again, it's 68% of the time. But we're going to go further than that. Once we know what volatility is, why not do a trade that has a 90%? Why not do a trade that has a 60%? You give me a probability, and we can give you a trade for that. Now that you may have to know a little bit about options for, but you give me a probability and I can give you a trade for it. EM equals expected move. Expected move, okay? And this is important stuff over here. Expected move, okay, has absolutely no directional bias. Expected moves are based purely on implied volatility model. So it's based, okay, on a nice big distribution curve, okay? However, recognize the implied volatility is based on live markets, whereby there are often hundreds of millions of dollars setting the volatility in options and expected move. What I'm basically saying is, some people look at this and they go, all right, I get it. It's, it's expected move. It's price. It's volatility. But how do I know it's accurate over there? Because every single expected move, once again, has hundreds of millions of dollars. Now, somebody asked a great question. They go, well, can we just use like average true range? Okay. Can we use average true range? And the answer is, well, why would you? That's based on past price movement. The problem with average true range or anything on a price chart. Okay. I'm going to tell you exactly what's wrong with it because you didn't think I was going to let that go, did you? Everything on the price chart. Does this price chart see the earnings? Does average true range feel the earnings? Because if information starts to come out about earnings, right? And this happens all the time. There's rumors floating. The stock may not move, but the options market may go crazy. Options markets, think about like an FDA announcement on some stock. Some biotech stock. It's a phase 3 trial. You find out, oh, the phase 3 trial's killing everybody. But there was rumors of that coming out like the week before. Then what do you get? You get like a Veritex Pharmaceuticals. That's probably a sore point for some of you. But anyway, you get what I'm saying. Expected move is phenomenal, though, in pricing markets. So again, now I'm going to get into more of like the brass tacks of like how do you use it, right? So using expected move. As I said, expected move can be a phenomenal resource. Selling options outside of the expected move can, instantly create viable trade candidates. But let's get practical here. Okay, time out for a second. I see markets becoming increasingly volatile. I mean, what else do you guys, what do you need to recognize that volatility, right, is coming? We just moved earlier this year down, okay, to 1,800 on the S&Ps. And here, we'll use a price chart for this. So why not have some fun with it? Because I'm actually going to put this into like in the end, brass tacks, right? You want to see how it works. Beginning of the year, where are we at? We're exactly where we are now. So we came off 250 points in the S&Ps, 275 to be exact. We rallied 275 points. You may not like it, but get ready, people. We're in volatility right now. Doesn't matter what the VIX happens to say. There's no risk in the market. Okay? Pick your poison of why there's going to be volatility. You realize in the last 3 weeks that every company has pretty much come out and said earnings, this is going to be like one of the worst quarters for earnings ever. Okay? JP Morgan today released earnings. Spectacular, but they already lowered guidance. Doesn't matter what you might think. Okay? Volatility is always going to be right around the corner. And one of the things that we do now, let's go through some of the stocks that you guys had mentioned a little bit earlier here, and let's discuss how you can actually use this stuff, right? So first and foremost, we'll go back over to, let's go to Facebook. Why not? Let's do it. We're going to Facebook. Okay. Close up everything. What's your trade in Facebook? Maybe you don't have a trade in Facebook. Maybe you're considering a trade in Facebook. Okay. Whether it's a stock trade or whether it's an options trade, it doesn't necessarily matter to me. But whatever the trade in Facebook is, it's a trade and it has risk. Let's assume that you went out and bought some stock. Okay. Now, is your trade going to be, Netflix? Somebody said Netflix too. Oh, yeah, Netflix. I mean, that one does it for me right there. It does it for me. So if you take a look at something like Facebook. Let's say initially, forget about options for a second, because again, I don't know if everybody's traded options, so I don't want to go, totally crazy on this. Let's say though, you go out and let's just call it buy. What's a fair number in here? Let's just start, okay, with 500 shares. Okay, so you buy 500 shares. Then what do you do? Anybody? Do you want to put a stop order in here? So put in a stop order. I don't know. So you bought 500 shares. Like, what's your risk? Well, the stock right now is basically at 110. So let's put in here a stop at, give me a price. Okay, big, I don't know, 105. Okay, so you go out and buy 500 shares, and you put a stop order in at 105. Okay, how long is this trade going to exist for? I mean, you guys tell me. You want to just do like one of the expirations up here? Here, let's make it 30 days. Is it something like that? 30 days. Okay, what's your target price? I don't know. Your target price, well, if you're risking 5, you might be able to make what? 10. So you're thinking it's going to go maybe up to 120. Okay. The first thing you do is just look at like the next 30 days. Is that even obtainable in the next 30 days? So in the next 30 days, the expected move is plus or minus $10, okay, and 58 cents. And we're going to stay in that range again 68% of the time. So we got a $10 expected move over here. So do you see a problem with this right away? Okay, you're dead on this trade. You are dead. I don't care what you know, what your technical analysis says over here, but the Fibonacci told me to do it. You're dead in here. And I'll tell you why. Normal volatility oscillation. Number one, there's earnings coming out, but let's exclude the fact that there's even earnings. Forget about it. Okay, why are you dead meat over here? Your target price. Okay, your target price is pretty much to the outside of what the market even expects occurring. Because you got to look at this and you got to ask yourself, what are the chances of going from 110 where we currently are all the way up to 120? Because that's what the market is telling you right now is like it barely even expects that kind of movement. But the stop order at 105, that's way easy to hit. That's only a $5 move off where we currently are. Think about it. That's the first issue with it, right? You're going to get stopped out on this thing. The probability of being stopped out is really, really high in this trade. So let's stop right there for a second. One thing you're learning from this today that you can use tomorrow. If you place stop orders inside of expected moves, you are asking for pain. And you're like, what? Where do you see that? Now I'm going to go a little further here. This is not on every single trading application. I can teach anybody about this. We're actually going to look at what's called probability. Okay, probability, what we'll term in the money, and there's probability then out of the money. So when you look at like probability in the money, okay, we have what we call probability out of the money, probability of touching. Okay, you can go through all the different calculations, but the one that should really grip hold, your probability of what we term touching, that's the probability at any time in the next 30 days that we go to 105, is almost a 70% probability. You have a 70% chance of getting stopped out. First rule of thumb, okay? Always place a stop order outside of an expected move. If you don't like risking $10, I am sorry. Ladies and gentlemen, you can't really do that trade. At least not for the next 30 days, because we are going to move $10. And the key is we can move $10 up, $10 down, but we could actually move 10 down before we move up. Okay? You have to recognize with stop orders, you're going to have to give the market room to breathe. By the way, there's no and or if about this. People look at stuff like probability of touching and they're like, it's a foreign calculation. We've done so many classes and so many coaching sessions specifically on probability of touching. I feel like I beat this one to death. Okay. But if you do, over the course of your investing career or trading career, whether you're an investor or trader, if you do enough trades, probability of touching always wins. If it says 70% over the lifespan of you trading, if you do like, let's say 100 trades in the next year, 70% of the time we would have hit 105. Maybe because it worked once doesn't mean it's going to work continuously, right? It's about number of occurrences out there. All right. And again, Facebook today. Why am I using Facebook today? Oh, I don't know. It had a low. Okay, but there's the exact reason I'm using it. It had a low of 106 and a high, okay, of 112. So what happened today? Oh, I barfed out of my position. That's what we call it. It's a very technical term in trading. They call it puking up the position. You either got stopped out or you got really close today to getting stopped out. Normal oscillation is going to stop you out of trades. This is the kind of stuff that you can immediately use expected move for, right? And got another one for you. So, again, it's interesting, but there's a lot more than kind of meets the eye over here. This takes, like learning, repetition. Repetition is going to be like the mother of learning in here. You got to see this stuff more than one time to learn how to use it. But I'm going to give you another one. And here's one. When I say volatility, okay, listen, it's coming. Like whether you like it or not, like it's coming. Now, I've been saying volatility is coming for the last 2 years. Okay. And I got to be very frank with you. You think I'm wrong on that front, but for the last 2 years, let's go back over here because some of you guys might remember. I've been doing classes for a long time. I used to do a chat room inside of thinkorswim. It was called Swim Lessons, but I haven't done swim lessons now since February of 2015 was the last swim lessons I ever did. But again, this is looking back over 3 years. So for pretty much 2 of those years, we've been up, we've been down, we've been everywhere but where you want us to go. Last year, 2015, what was the return on the S&P? Absolutely zero. This year, where are we at right now? Look, the market's actually up now year to date. Don't worry, give it a day. Maybe it'll be down. Doesn't really matter, okay? The point being is there's going to be volatility coming, and we're going to be in it. Get ready for turbulence. We know that eventually they're either going to raise rates or go to negative rates. You got to love that. So the FOMC, we're either going to be raising rates or we're going to be in negative interest rates. But ladies and gentlemen, we are going to do something. Thank you very much. That was my Janet Yellen impersonation of the day. I'm going to actually show you how to use this now. So whatever stock you may be, and I don't know, let's go to something that's considered boring, like Disney. Disney lately, though, hasn't been boring. This thing has been on fire, okay? With a stock like Disney, you might be an investor. You're going to hold this stock and you own, let's say, 1,000 shares of Disney. That's not necessarily the right thing for everybody, but this could be your 401k. What kind of risk are you going to take in the next 90 days? Look at 90 days. The expected move is, let's just call it $8. It's plus or minus $8. That means this one position is going to be the equivalency of plus or minus $8,000. And I'm telling you something about this. This is the normal occurrence. This is 68% of the time. But what I haven't talked about is you can actually take this expected move. That expected move equals 68% of the time. You can take it and you can double it and go plus or minus 16. And that equals 95% of all occurrences. Now, ladies and gentlemen, are you prepared to take a $16,000 hit? And then you get one of the oddball occurrences, which is a 3 deviation move. So actually, for those of you that are speak geek, it's a 3 deviation event. Okay? There's even black swan events, which are like 4 and 5 deviation. So you're looking at a $16,000 profit and loss. That's in Disney. That's the most mild animal there is in the business. Okay? And there's no joke of that. You want some of the more wild animals out there? Okay? This is like going to Netflix. This is like visiting the zoo. So when I say a wild animal, because their volatilities, they're high. All right? Don't make me have to go to Tesla. But if you own, okay, and just bear with me for a second, because Tesla seems mild, right? It's just a $100 stock. You own 100 shares. Do you realize this thing, a normal move in the next 30 days, is plus or minus what? $15? On an oddball move, and by the way, this stock has been known for a 5 sigma move. It happened a couple of years ago, moved from $140 to $164 in 2 days, a 5 sigma move. This can easily move plus or minus what? $30. What I'm using this for is to measure your risk. Again, I wanted you to be able to leave tonight and be able to use something tomorrow to like start to measure like how deep am I in? Like, do you justify holding your positions? Because if you can't take the heat, you got to get out of the kitchen right now. All right. There's no time over there. And what you're going to find is people don't size their positions accordingly. Like if you can't take a $16 swing in the next like month or a $15 swing in the next month, you got no business of being in here, because it's not saying that this is an odd occurrence. This is saying it is the most normal occurrence. That's 68% of the time. That is going to happen. What's going to be odd is when it moves $30. That'll scare the heck out of you. I mean, you start looking at a chart over here. What do you see in a chart on the 3-year daily? Okay, I'll tell you exactly what I see. A gap-filled wonderland called Netflix. Right? And there's a lot more stocks that I can pull up in here that are every bit as volatile over there. And again, I like to use like a live trading application to do this because it speaks volumes about what people's risk are. And by the way, ironically, the Tesla doesn't have volatility much higher. Okay, so what you start to do after a while, and one thing that I like to, kind of leave people with this thought, then you start comparing one underlying versus another. Like you look at Tesla, and over here on the right-hand side of the screen, it's got like 60% vol, right? Then you go over and look at another underlying. Okay, what other underlying? Let's go look at Walmart. What do you do with Walmart? And it's got like 15% vol. Do you realize that, yes, Tesla is 4 times the risk of Walmart? It's telling you there's 4 times the risk. The options market is distinctly telling you there's 4 times the risk over there. Okay. Moreover, there's tools designed for you to look at what your risk happens to be plotted on a chart. Because if you are a market technician, I get it. Only a handful of people use, some of the right studies on here. And I'm just going to go over to add study, under volatility studies, and up to probability of expiring cone. This is a study. And by the way, there's all kinds of proprietary studies that we have built here at TheoTrade. People get into proprietary studies. Everybody has got some kind of study that's right for you. We build code for studies, okay? It's part, like that's what we do at TheoTrade as well as like education, but, there's no sacred cow. Like we don't hold any proprietary studies. If there's something that we use, we give it to you. We don't charge for it. We give you anything that you want in terms of studies that we might use. This probability of expiring cone, this is kind of one that it's on the thinkorswim trading application. There's actually code to put this pretty much in any trading application. It's pretty easy to do, but it's giving you a projection window. And the projection window in this probability cone, and I'm going to freeze the screen, okay, right up here, it's actually telling you it's 68% of all occurrences. It's actually predicting, what? We go to 206 or 303. But here's the irony in that word, predicting. Not predicting. It's actually using the options implied volatility to extrapolate stock price movement. It's one of the only studies on any charting package, out there that uses implied volatility to extrapolate forward price movement. And that's one of the first things that I try to instill, whether you trade options or not, That's fine. Like, I get it. Like, not everybody wants to get into options, but this stuff, it can be used for it. So using the expected move, again, it's how many different trades can you build from this? Okay. It's, by the way, somebody said, I like you don't nickel and dime for every class and indicator. No, we're not ever going to do that. Like, I can't stand, like, there's the latest, greatest indicator. You must buy it. It's crazy. It's insane. Okay. I don't like to sell indicators based on what? Price and volume. That's it. Like, you look at a data package over there, price and volume. So if we come up with some indicator, gold, you can have it. I mean, again, no sacred cow, because there is no silver bullet to a marketplace over here. By the way, for those of you that are math geeks, I threw this slide in here. Oh, just for the hell of it over there. Math geeks and engineers, here you go. I am sworn to secrecy, regarding how thinkorswim derives the expected move. I always say if I tell you the real calculation for expected move, I will be in cement boots inside of the Chicago River. So that is, there's an individual here that's from Chicago. Yeah, I actually love it there. Okay. I do miss the summers in Chicago, but those days are behind me. The single days are behind me. I decided to pack it in, got married, 3 kids, yada, yada, yada. I'm 40. Most of you know what I'm talking about. Anyway, roughly this is how you solve for it. If you're curious, I'll just include this in here. So it's one standard deviation. Some people just like to know the math behind it. Okay. The probability cone on thinkorswim, it's actually called a probability of expiring cone. And the probability of expiring cone on thinkorswim, fun story there, it came out of a trip to San Diego with a couple of software developers, myself, Tom, another guy by the name of Steve, and we went to a trip to San Diego with our software developers to an actual trade show. A few beers later, we started building some good technology, and that was one of them. That was probability of expiring cone. So anyway, here's some strategies surrounding expected move. Iron condors, vertical spreads, butterflies. All of these are practical trading strategies, right? Every one of those is a practical trading strategy that you guys can use around that. And so, again, I'm just kind of going through that. But one of the things I want you to realize, like the most practical thing to do with expected move, and the most practical thing to do out of this data that I'm giving you, tonight, is to recognize, first and foremost, look at your position. Like right now, tomorrow, whatever, look at your position. Okay? Reconcile your position. Like go through your position and go, okay, I have 300 shares, okay, of Netflix. Netflix in the next 30 days, okay, has an expected move, let's say, of $15. Is that going to hurt me? Financially, is it going to hurt you? Don't look at Netflix being able to move up. Look at it, look down, plus or minus. Always remember that. That's what I want you guys to be able to solve for immediately. Okay, immediately. And that is probably first and foremost. All these other things, the iron condors, of course, we did a course in iron condors, vertical spreads, selling vertical spreads outside an expected move. Why? Because it immediately can give you, okay, not even a 68% probability. You can build a vertical spread that has like an 80% probability just by going outside the expected move. In fact, it's even higher than that. Butterflies on the edge of an expected move. If a stock is, likely to oscillate in an expected move, what's called a butterfly, okay, at the outside of an expected move could be an effective means of profitability. That's what a butterfly, by the way, and an iron condor profit and loss graph look like. But again, I always key into this. The first thing I got to do, all right, and I kind of feel it's like our job at TheoTrade, the first thing I got to do, get you out of harm's way. And I wouldn't say that, okay, I wouldn't say get you out of harm's way if I didn't believe like risk is coming over here. And you just have to recognize, I don't say that to try to intentionally scare you. I say it because risk is coming. You got to strategize around it. You got to be able to sweat out the fact that we're going to see not only expected moves, but expanding expected moves, right? Volatility expanding out over time over here. So that's, I guess that's a little bit about expected move. I mean, it's quite a bit to know. So we're going to move onward and upward for those of you, again, that are TheoTrade members. I want to thank you guys for joining us tonight. For those of you that are not, okay, stay tuned because we're actually going to go through over here quite a bit more for you. So again, I want to kind of hop into this and take everybody through just a little bit about the about TheoTrade and kind of introduce you a little bit here to TheoTrade. So yes, it's a giant TheoTrade. So again, I want to take a moment to tell you about Total Theo, which is our monthly subscription service over here. So again, I'm going to take a minute and talk a little bit about TheoTrade because there's a ton of questions, a ton of trading questions I'm absolutely going to get to. So TheoTrade, we're an educational platform designed by professional traders. Our goal is to help you learn successful trading techniques, okay? We offer classes each month designed to help you become a successful trader. These classes are developed by me and other traders that have at least 15 years of trading experience. We've got Tony now on board. We've actually got Doc Severson. Many of you guys are familiar with Doc on board. Okay, we've spent hundreds of thousands of dollars in the market education over the years to develop strategies that give you a higher probability of success. We offer these classes as online seminars, okay, and an investment. They're $150 each. We used to conduct live workshops, okay, that offered similar type courses, okay, and those live courses, they were $3,000 per person. As you can agree, $150 for one of these courses, it's a bargain compared to the $3,000 over there. So if you took one of our classes each month, okay, you'd be investing $1,800 per year in your education. So that is minimal when you consider how much the strategies, okay, you're going to learn and, make you over the next trading year. So again, learning these strategies, becoming effective with them over the next trading years, again, $1,800 per year is nothing in comparison to that. But even more important, I know that you will most likely lose 5 times that. Okay, and how? And it's by not having the techniques we're going to provide you that will help you limit losses and mitigate risks, similar to expected move over here. We have found that most self-directed traders like you need more than a class a month to keep you sharp and successful. We have found that our clients can be twice as effective, confident, and profitable if they have a resource they can go to daily. A reliable daily resource based on the current market trends, news, and countless other factors that can impact your trading on an ongoing basis. And that's why we developed Total Theo. So let me tell you guys a little bit about Total Theo. So Total Theo, it's a monthly resource that provides you limitless access to our entire library of educational programming. Okay, the investment to you for Total Theo is $150 per month if you order it on a month-to-month basis. Okay, in a moment, I will tell you how you can reduce that monthly investment if you order it in a 3-month or a yearly basis. But first, let me tell you what Total Theo includes. So number one out there, Total Theo members, okay, you're going to receive after the close of each trading day our Theo Night video newsletter. This video, it's going to dissect the market activity from that day, sharing with you the source and the cause of the market moves of the day, what to expect, and how to prepare for the coming trading day out there. So I'll tell you this, early in my trading days, I'd have paid $100 or more per day for the professional, to help me kind of understand what just happened, because everybody needs to know kind of what happened and really prepare for the next trading day mentally. So number 2, as a Total Theo member, you'll receive our daily coaching program that we call Theo Coach. And that's actually the session that you guys are attending tonight is, through our classes, we will teach you unique strategies that you can place to take advantage of any market condition. Theo Coach will help you implement them on a daily basis. So Theo Coach will focus daily on strategies that work best for the current markets, how and when to place and close these trades, how you receive invaluable insights each day on timely topics such as scalping. We do some trading, some scalping on an intraday basis, talk a lot about volatility, verticals, etc. But really, Theo Coach is the closest thing to having a professional trader assisting you with your trading each day. I always say this, what do you think it's worth to kind of look over my shoulder throughout the course of the day, my shoulder and the shoulder of several other successful traders. Number 3 here, Total Theo members, okay, have weekly access to Theo Evening. These are weekly evening coaching sessions on subjects like swing trading, managing a portfolio, hedging, and more. Again, that is what you're actually attending tonight. These are different, okay, than our $150 class offerings and not usually available to the general public. Obviously, we open this up tonight. These sessions are only available to our Total Theo members. Number 4, Theo Chat. Here, you're going to have access to other Total Theo members and our staff of traders to share trading tips, experiences, what's working, what's not, as well as what stocks kind of hot, in play. You'll be plugged into a community of Theo traders, kind of stimulate you, excite you, trading every day. It's fun. Number 5, you'll have access to Theo archives. If you miss something we say, just don't sweat it. Every single ounce of what we do is recorded and it's archived. Watch it on demand, okay, from any device at any time over here. And finally, number 6, as a Total Theo member, you're going to receive access to Theo class. These are our monthly classes we offer to the public at $150 each. But as a Total Theo member, they're actually included at no additional cost to you as part of your Total Theo subscription. So I'm urging you guys, take advantage of Total Theo. All right. It's one thing I wish I had, when I started out, learn how the market kind of really works and save yourself years of losses. Execute the exact strategies. In fact, the exact trades that we're doing used by top professionals, and the step-by-step criteria for implementing them. I'm huge into criteria, and that means recipes for entry and exit of trades. Finally, understand how to cut your risk and to hedge your portfolio. Join a community of real traders. Look over the shoulders of daily, just all day long, of veteran traders with 15 years of more of experience. All TheoTrade has to offer daily at $150 per month. That's just the price of one of our classes. So now, if it's not enough, okay, I'm about to give you an even better incentive to become a Total Theo member. And as we said before, on a month-to-month basis, the investment in Total Theo is $150 a month. But wait, okay, as a special introductory offer over here, if you subscribe to Total Theo for 3 months, your total one-time investment is $297. So we just work it out to $99 a month. Plus, okay, you get to lock that in for life. So if you go out, sign up for Total Theo, $297, that price is locked in for life. It's $99 a month. So just imagine, all TheoTrade has to offer, okay, for 3 months for less than the cost of most classes out there. So for a limited time, the 3-month Total Theo offer includes 2 invaluable bonuses. So if you sign up for 3 months for Total Theo, number 1, we're actually going to include Survive and Thrive in Extreme Volatility. Okay, that's the bonus. That's really what I kind of call it, saving your bacon, because again, extreme volatility, it's around the corner. Whether it comes the next month, the next couple of days, Survive and Thrive in Extreme Volatility, can't stress it enough. It's $150 value on every class over there. Bonus number 2, Options 101. This is, again, the basics and beyond. It's a 5-part series, $150 values. If you're an options newbie, okay, or just a little rusty on it, I suggest everybody go through this because I can teach anyone the basics of options out there. So now, if you want an even better opportunity, I got just the thing for you. If you make a one-time purchase of Total Theo for a year, the investment is only $997. That works out to about $83 per month. That's 45% off just the cost of one of our classes out there. And we do have a guarantee over here, and here it is. If you sign up, okay, for either the 3-month or the 12-month program and decide later you don't want to continue, okay, great. We will prorate the months you used at the monthly rate and refund you the balance. Okay, so there's absolutely no risk to TheoTrade or Total Theo, because again, whether you do the 3-month or the 12-month over there, you decide at a later date you don't want to continue, again, we will prorate the months used. So you still have access to some of the bonuses. You have nothing to risk by investing, okay, in Total Theo 3-month or 12-month subscription. We want to make this an easy decision for you. I want to make that crystal clear. When you sign up for Total Theo for 12 months, okay, you get these invaluable bonuses. The 2 bonuses I talked about earlier were obviously Survive and Thrive in Extreme Volatility class. Again, that alone is worth its weight. Number 2, the Options 101, the Basics and Beyond, the 5-part series. In addition to that, if you sign up for the 12 months, okay, you'll get 3 additional bonus classes, including, okay, and here again, this is the 3rd one, Iron Up with Iron Condors class, because somebody was asking about Iron Condors class over here. With the market, again, will the market go up or down? What's it going to do? Volatility would be wonderful in here. You don't need, okay, and don't care when you trade Iron Condors about market direction. It's a bona fide market neutral strategy. Volatility would be prime for Iron Condors. Okay. Bonus number 4, sell premium and minimize risk class. This is kind of like my mantra in trading. So over the duration, selling premium, it's the premier way to generate consistent market returns. And everybody that goes to this class, they kind of call it the selling premium. It's the MBA class of of trading, and it really is. This is about as hardcore as it gets, and I let you know that now. Bonus number 5 over here, high probability trading with in-out spreads class, a $500 value. That's a class I just recently did. It's the only what we call risk one to make one trading strategy designed for small account traders, and that's designed specifically for small amount, account traders over there. So again, you kind of may be thinking, I have time to take some classes from you, but I'm not sure I have time to take advantage of all that Total Theo has to offer. And it's a lot. You got to remember this. TheoTrade, it's designed, by busy traders for busy traders. And that's why we have specifically designed our classes to save you time by shortening your learning curve. We'll also save you time, by our on-demand archives over there. You can watch day or night, right? It's 24/7. On your time, on your schedule. Yes, we're mobile friendly. You got an iPad, an Android over there. You can watch it on anything. And let me say this again. If you decide to take just one of our monthly classes, you'll be investing $150 a month, and only getting one class. So subscribe to Total Theo today. Take advantage of the special offer. You're going to be getting at least a new class each month, plus everything else TheoTrade has to offer. So that is the daily access, the aftermarket video newsletter, right? The daily coaching program, the weekly coaching session, all the archives, the chat room, and more. And again, chat room is going for 4 hours a day. We have futures traders in there, option traders, stock traders, whether you have a small account, a large account, everything that TheoTrade has to offer at no additional cost than what a single class per month would cost. Everything you need, when you need it, at your fingertips over there. Look at TheoTrade as kind of your arsenal or your toolbox. So you may not use every tool we offer every single day, but the tools are always going to be there whenever you need them. And you have them for no additional cost, than when you pay for a single class. So Total Theo, it's your ultimate kind of trading toolkit, and it's always going to be there when you need it, from again, classes to the archives to coaching sessions to support to, of course, all the indicators that we provide out there. There are only 252 trading days in a year. If you take advantage of the annual subscription, that's, of course, the 12-month subscription, the investment is $3.95 per day. That's less than your Starbucks latte over there, only $3.95 per day to have at your fingertips all of the resources and the help you need to be a great trader. So when you subscribe, the investment is a latte a day. You can agree the investment's minimal. However, the cost, if you don't subscribe, I think it's going to be hazardous to your portfolio. So not too many people know this, but the horrifying reality is, again, a sudden downturn in the marketplace, people are going to lose half their money, or their entire net worth by not knowing the proper strategies and the steps for hedging the portfolio against losses. And it's happened to too many people. I've watched order flow at a brokerage firm for 15 years. I don't want this to happen to you. So, but by not knowing what strategies to use and the proper time and criteria for opening and closing a trade, it could cost you thousands. If you don't take advantage of Total Theo, I think the cost is going to be much greater for you. So enroll for Total Theo right now and take advantage of our introductory offer. I think it's the best trade you're ever going to make out there. So here's what you're going to do to enroll. So open your favorite web browser and go to, it's just TheoTrade.com/total. And I'll put this up there a number of times, TheoTrade.com/total. You're going to see 3 columns. And with those 3 columns, 3 options. Options number 1. On the far left is where you sign up for the monthly offer. Option number 2, in the middle is where you sign up for Total Theo for 3 months. Option number 3 on the far right is where you sign up for Total Theo for 12 months. If you decide on Total Theo for 12 months, click the Add Cart button on the far right. An order form is going to come up. You can pay by credit card. You can pay by PayPal. Add your billing address and credit card information to the form. After you click place the order, a system is going to generate login credentials for you. Check your email within about 20 minutes. You're going to receive an email from us with your login credentials. You can use, again, immediately to access Total Theo members area. That's all the archives immediately. So, all right, so let me recap some of the different options over here because we've gone through a lot about TheoTrade. If you really want to keep your trading skills honed, your risks minimized and your portfolio strong, no matter what the markets are going to do in the coming months, Total Theo, I think, is the better choice for you. Your Total Theo membership includes any classes we do, okay, for the months you're a member over there. So just go to, again, it's TheoTrade.com/total. With Total Theo, we have options really for every budget. You can choose the $150 per month, which is the left column. You can choose the $297, okay, which is a one-time payment. That's 3 months. It works out to $99 a month. It's an even better deal. And you get the 2 bonus classes, which of course is the Extreme Volatility class and the Options 101 class. You can choose the yearly, the annual subscription over there for $997. Again, it's 12 months option. It works out to $83 a month. It's the absolute best deal, and you get 5 bonus classes, which is, again, the Volatility class, the Options 101, the Iron Condors class, the In-Out Spreads class, and, of course, kind of my mantra is the Sell Premium class. So, again, at TheoTrade, we're committed to bringing you the best trading education on the planet, and we're honored to offer you, a home where you guys can kind of finally get trading expertise and guidance you've been searching for in order to be, successful out there. So, put our years of experience to work for you. So if you only want to get classes, okay, so we still do offer just classes, then this is the link you can go to for that, and that is TheoTrade.com/classes. Our classes start at $150, which is a great deal for the level of trading education on very specialized subjects. So you can buy just classes. You can get those classes, okay, one at a time. But why not just go out and buy Total Theo, okay? And ultimately, for a year, you get the next 12 classes, all right, for free with Total Theo for 12 months. So again, it's TheoTrade.com/total. And I'm going to take you over to the webpage over here so you can see exactly what this happens to look like. So again, choose from any of the options below. As we were saying, here's the Total Theo, the monthly. This is $150. That ultimately has access, again, to the class of the month. Each class, okay, is coming again monthly. Our next class will be up in we're looking at, I think the second or third week of May will be the next class in the schedule over there. The daily coaching over here, the evening coaching sessions. All right, so that's Theo Evening, all of the archives, and again, all 15 years plus experience. If you continue on, okay, to Total Theo for 3 months. And that's what we've been discussing here. The Total Theo for 3 months over here, as I kind of scroll down, it's everything that's in, okay, the monthly subscription. Obviously, okay, it's $297. It breaks down to $99 a month, but it includes the additional bonus classes out there. And the bonus classes, Survive and Thrive in Extreme Volatility. Bonus number 2 is Options 101. Right? All you have to do, again, top, click Add to Cart. You're ready to go. Last, but definitely not least, is Total Theo, the 12-month subscription. Okay? That's everything that we do in addition, again, to 5 bonus classes. And I'll scroll right down to them. Survive and Thrive in Volatility, the Sell Premium, okay, and Minimize Risk. Now, some of these classes alone, you guys have been to classes that charge anywhere from $99 for a class all the way up to $1,000 for a class. I will put each and every one of these classes against anything available or out there. Okay, anything, you name it. The high probability trading with In-Out Spreads class that we just recently did, you guys, you're going to love it. Absolutely going to love these bonus classes in there. So again, we want you. Join us here at Total Theo. Again, I'll throw up the web address, answer a couple of questions. So it's TheoTrade.com/total. Again, it's TheoTrade.com/total. Literally after you hop in there, log in again. So add to cart. 20 minutes after that, after we verify information, you're ready to roll. So you can start going through some of the archives, some of the classes tonight, if you would. Okay. All right, reading through here. Just reading through a couple of questions over here. So if you get the 3-month plan, then every month, okay, after is $99, okay? So excellent question over here. So let's say you sign up for 3 months, okay? You've actually got options at that, all right? You lock in the $99 per month rate. That's it. So if you sign up for $297 today, you've locked in a $99 per month rate thereafter. The other thing, and it comes up, and I've seen the question already in here, could you just pay another $297 for the next 3 months over there? Absolutely. Without unequivocation, we say that over there. All right. Scrolling up a little bit over here. What about some of the previous sessions? Now, when it comes to the coaching sessions that we do, okay, tonight, which you guys actually attended this evening, was actually a coaching session. We had our members on the coaching session tonight, and then I cut them off and kind of continued with you. That is what a coaching session's like. Usually it's a very directed topic. You have access to every single one of those coaching sessions, okay, from the beginning of time over here. There's a tremendous amount of information, okay? We are in the midst of also building out a very formal curriculum. I strongly suggest, okay, that you do the 3-month or the 12-month. And because I'm saying that, these include, right, the Options 101. Even if you have options experience, the way that I go about teaching options is much more from a probability perspective. And this is it's a 5-part course. They're 45-minute chunks out there. And I kind of get you ramped up from the start that I probably had in options, which is price and probability. So as we continue on here at TheoTrade and more coaching sessions, we're going to build off of this Options 101 data over here. Not to mention, when you start looking at the 1-year program, again, the Sell Premium class alone, for those of you that already have some experience in trading, is worth the $997. And again, I will put anything into that. When I say anything into that, I mean, all right, that's pretty much like the heart and soul of my trading is selling premium and kind of managing the risk behind it. If you're into Greeks and so forth, that class is as hardcore as anything out there, okay, offered anywhere. Not to mention, there's an entire week, okay, of sessions that follow up on this thing. The other one that I feel pretty strongly about is, of course, the in-out spreads class. So it's something that I constantly trade in our chat room. And one area that I didn't even discuss that kind of came up over here, and I wanted to bring up, somebody brought up McDonald's. McDonald's has a cup of coffee for $1. Okay, you're right. One of the things I was talking about McDonald's for a moment, because I do a lot of these in-out spreads throughout the course of the trading day. Now, some of you, if you're tuning in, you're thinking like, I can't tune in every trading day. I work for a living. It's fine. We actually built what's called the TheoTrade tracker so that at night you can actually log in and you can see the trades that I did throughout the course of the day. And these trades are not like in, out, in, out, in, out, right? We do some intraday trading, but the trades that we're doing, they're more positions. Okay, and I was thinking about McDonald's because I actually have a bearish spread in McDonald's right now, as well as one in Home Depot and a few others. But the high probability in-out spreads class, it teaches the criteria behind that. Then, when you're a member, you go into the TheoTrade tracker even at night, and you can just put the spreads on, just execute the trades the next morning, okay? Or, again, the next day, or check out the TheoTrade tracker. So what you're doing is you're capable of not only tracking, but placing the same trades along with us. And it's just an area, I didn't even discuss tonight. Not to mention, we also have an entire area for members for them to look at the studies, any proprietary studies that we have over there. It's all part of being TheoTrade. So for those of you also, there's a couple of people that were questioning a 1-800 number. So I will give you that right now. If you need a number to call over here, obviously, we can have you come in here and ultimately register online at, again, theotrade.com/total. Let's go ahead, though, and paste the number in there. It's 800-256-8876. Again, that's 1-800-256-8876 is our 1-800 number. So feel free to give us a call over there. That, I'm reading down here. Don, generally speaking, are there butterflies safer than iron condors? Joe, absolutely. In fact, one of the next classes that we have coming up this summer, we're going to do a class on butterflies. Okay, I'm even going to do another one on broken wing butterflies. Somebody said, if I need help with TOS mechanics. So we have an entire area for members that is thinkorswim demos. I shouldn't tell you that, but there's lots of thinkorswim demos built into TheoTrade. We'll also help you a tremendous amount in terms of mechanics of thinkorswim. I use it during the trading day, okay? But I want you guys to know, like, you don't feel like, you have to be on thinkorswim. Of course, I have experience over there. I worked there for 15 years. Nevertheless, we've got several different broker-dealers, of course, that we're dealing with. For those of you, though, however, if you're interested in an account, thinkorswim, of course, is owned by TD Ameritrade, or you have an account with TD Ameritrade, we have a negotiated commissions rate with TD Ameritrade, okay? For those of you that do trade options, it's a negotiated commission rate. That rate cannot be discussed in any open forum here after you are a member, okay, of TheoTrade, and you must, and I say this without unequivocation, okay, you must be a member, a verified member, okay, of TheoTrade prior, and we will give you then the directions to get the discounted commission rate at TD Ameritrade. For some of you, that alone is going to be worth it, but we do not use that, okay, to ultimately say, oh, you got to be, a member over here. It's just, again, kind of one of the bonuses. I have a very good relationship with TD Ameritrade. I'm going to keep that relationship. It's a $20 billion company. It's probably a good relationship to have for the long run. So, Mike, we also, of course, futures. We can absolutely talk to you about futures. Just so we're clear, we have a futures trader that joins us every single day, okay? Every single day in the chat room. His name is Tony Rago. He's phenomenal. You guys will love Tony. If you do have the time to trade every single day, he is phenomenal over there. So you will love it. I'm big on Tony. Big fan of his, and I don't say that very often. So, all right. I want to thank everybody. I got almost all of that. And by the way, Joe's asking a question. Can I get a lower rate than that? Yes, Joe. It will be lower than the rate that you just discussed a moment ago. So don't you worry. I'm taking good care of those clientele, what we call Theo traders. So again, I want to thank everybody for joining us tonight. Again, just come over here, theotrade.com/total. The number is 1-800-256-8876. Thanks a lot, everybody, for joining us tonight. And we'll be in here for a few more minutes to answer a couple of questions by typing them in. Otherwise, have a great evening, everybody. Bye-bye.